Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Welcome to everyone already in the chat. If you can give me a thumbs up that you can hear me and see me, that would be great. And what I thought I'd do today, of course, we're going to be pretty much covering whatever you want to cover. For those watching live, make sure if you have a topic you want me to cover to tag me. And thanks for the thumbs up. Tag me in the comment so that I can, it shows up bright orange, and that way I spend less time scrolling through all of the comments. I thought I'd just start off though with a topic, and that is the Fed and inflation and their approach, as many of you have probably already read about. Their meeting concluded yesterday, and Chairman Powell had a press conference. And the long story short is, and I don't think this surprised those that focus on this in the press, but what they're going to do is speed up the I guess tapering. So the Fed is buying bonds every single month, and they have been for a while, and they were slowing that down to the tune of 15 billion a month, and at that rate, I think they would have gotten to the point where they weren't buying any more bonds. I don't know, middle of next year, let's say, something like that. And they're going to bump that up to 30 billion a month. So they'll step it down 30 billion a month, which will conclude the bond buying first quarter of next year. So what's that mean? So you can think about the Fed buying bonds. So they're literally going to take bonds out of the market and in exchange, obviously put cash in, whatever they paid for the bonds. And so that floods the economy with cash. But the other thing it does is it artificially increases the price of bonds, right? So if you think about it, they're artificially increasing demand, right? The Fed steps in, they're a buyer. So it's like imagine the government stepped in and started buying all of the bread at your local supermarket. All of a sudden, there's not much bread left. What's going to happen to prices? They're going to go up. Well, that's what they're doing in the bond market. And of course, what happens when bond prices go up? Yields go down. And that's no different than stocks. Stock prices go up. Dividend yields and earning yields go down. So same thing in concept. So they're slowing that down at a faster rate, and eventually we'll get to the point where they're not buying any more bonds. And the second thing they've said is they're looking at 3 interest rate hikes in 2022, and I think they may have said 3 in 2023. I kind of view those with a healthy dose of skepticism, not because I don't believe them, of course. Well, I shouldn't say of course, but that's not why. It's just that so much can happen between now and then. Who knows what's really going to happen? The old saying, if you want to make God laugh, tell God your plans. Well, the Fed's telling us their plans, and that's fine. The market reacted positively. I don't think it really surprised the market. I'm looking at it now for today. I can show you this on my screen, I think. Yeah. The market, I guess, is flat, really. Nasdaq's down, Dow's up a bit, S&P's basically hasn't budged. Bank stocks are up, so I'm happy about that. My Apple stock is down, but whatever. In today's morning shows, I watch Squawk Box a bit, and the question was, why is the market reacting the way it is, and shouldn't the market react differently? Because shouldn't this be an indication that interest rates are going to go up? And my take on that is a couple things. First of all, I don't read anything into what the market's doing today or yesterday. The market does what it does. It fluctuates. I mean, longer term, we don't know how the market's going to respond. But that being said, I think the market is probably happy with a couple of things. One, that it's in it appears anyway to be an orderly process. They're not making massive moves quickly. Two, they probably see it as a way to keep inflation in check, right? I mean, that's ultimately why the Fed is doing what it's doing. And so that probably eases some concerns. And they're doing it, if you think about the interest rate increases, they're still, by historic standards, going to be extremely low. So, it's not as if we see, 12% interest rates around the corner. The one thing that's of interest to me, and I don't know if Powell mentioned it, he may have. I didn't actually watch. I read about the press conference. I didn't watch it. is it's one thing to stop buying more bonds, which they're going to do first quarter of next year. But then the big question becomes, when are you going to start selling the bonds that you have, which of course is going to have the opposite effect. It's like the government comes in and puts a million loaves of bread on the shelf at the local grocery store. Have a nice day. And now prices plummet, and the grocery store has to lower the prices. They got to get rid of all this bread they've now got. And of course, if that happens in the bond market, prices go down, yields go up. Yeah, we'll see what happens. It's interesting too to me that I don't think Bitcoin did much. I'm just looking up the price now. I don't own any Bitcoin, but that's up 3.5% over the last day, I guess. That's up something. Ethereum's up 12%. I do own a little bit of Ethereum. I'm not a believer of investing in crypto at all. I view it not unlike playing craps in Vegas. And I'm not kidding. Which means I have very, 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 very little, and it's fun. So whatever. Oh, one other thing. I thought this was kind of funny. I'd done a video a while back about how I was not bullish on ARK, Cathie Wood's ETF, one of her ETFs. And it wasn't any great analysis. It was, look, it invests in companies that don't make any money and that are extraordinarily, the prices are just crazy. That was about it. That used to matter, by the way. At one point, that kind of mattered, you know. But in any event, I got a lot of flack for that. Now, it's turned out she's had a bad year. She's down 25% on that fund. The S&P's up 25. But even that, I mean, you know, great funds sometimes do that. I mean, so that in and of itself, I don't really read much into it. But in any event, I got an email from a listener named Howard who said, "You are too nice, so I will say it for you. Told you so." And he linked to 2 articles about Cathie Wood. And he says, "I know she is super smart, but after listening to her for 15 minutes, I can say I've never been less convinced by an investment argument. Thanks for the warning." And the thing that caught my attention in this article, and I'll actually show it to you. This is on Yahoo Finance. Despite the big plunge, Cathie Wood sees her plan returning 40% annually in the next 5 years. Here are ARK Invest's latest buys, and there's Cathie Wood and an article. The thing that troubles me is this right here. She sees her fund returning 40% annually. And to me, that is a big red flag whenever someone predicts the market. It's one thing to say, we're investing in these companies and we think they're going to grow their revenue and their profit, and here's why, and here's the analysis we've done. I think that's all normal, fundamental analysis. But then to say, oh, and by the way, we think the market will respond to that and be up 40% annually for the next whatever, in this case, I think it was next 5 years, that concerns me, because that to me is a belief in something she has absolutely no basis, in my view, to believe that. Not because her analysis of the company could be perfect and spot on, but that tells you nothing about what the market's going to do. And you know, history tells us that the market is fickle and unpredictable, and I firmly believe that. Now, I think in the long term, I think eventually the market brings you prices that reflect the fundamentals of whatever the investment is long term. But to say it's going to do this over the next year or a couple of years, that concerns me. It's funny because Warren Buffett says that kind of prognostication tells you more about the prognosticator than the underlying investments. And I think that's true. And that gives me concern. I don't have any ownership in any of those funds, so I suppose it doesn't give me that much concern. I don't know. All right. So I'm going to jump into the chat and go through your questions, your topics. Again, if you're just joining and you want me to cover a topic, please tag me in your comment because it shows up orange. Oh, also, I will add timestamps again. No one added timestamps for me last week. I was very disappointed in all of you, but I added them. That's okay. And I'll do that today. What else do I have to do? Play chess? All right. This first one didn't tag me, but I saw it, so I'll mention it. I think this is the one. Yeah, from LT. Hi, Rob. Thanks for helping us have a 457 plan with an old employer, which I think are mainly like for state government employees, right? I think. I've never had a 457 plan, but I do know it's a retirement plan. 457 plan. Yeah, it's for public service folks, I think. Yeah, anyway. With an old employer, which is switching to Voya Financials, was getting 3% in the stable account, no longer available. So that's a stable fund. Which bond fund do you recommend? Well, it's an interesting question. My approach has been, and I've mentioned this before on the show, all I can tell you is what my approach is. One is I generally stick with intermediate term bond funds, meaning funds that have a duration of, let's say, 5 to 10 years. Anything shorter would, I think, generally be considered short-term fund. Anything longer, long-term duration. And one way to think about duration, so let's talk about that first of all. One way to think about duration is, when will you need the money? And so if you're investing and you've got years to go for retirement, I think intermediate, some might even argue a long-term. It's just, for me, I've never been long-term. Even when rates were different, it's hard for me to think that now would be a good time for long-term bond fund. Although, as low as rates are, they could go down. And if they do, long-term bond funds make a lot more money than intermediate or short-term. Remember, for a bond fund, and I can show you this, we were looking at tax-exempt funds last week. I'll just show you this one. This is Vanguard High Yield Tax Exempt, and it's got an effective duration of 5 years. You see that there. So what that means is, if interest rates go down by 1%, the value of this fund goes up by roughly, it's a rule of thumb, roughly 5%. If rates go up by 1%, the value of the fund goes down, again, roughly by 5%. So I've always sort of been intermediate term, but I think if, one argument is you should, if you need the money sooner than that, you might want shorter duration bond funds. And I get that. But I think even in retirement, when I'm relying on our investments, I'll likely just keep intermediate term bonds. I'll have some amount of cash. I've mentioned this in the past. It certainly would be under a year, and then just rebalance. But in any event, for me, it's intermediate term. And then I think just a healthy mix of what I'll call nominal bonds, which would be treasuries or total bond fund. Nominal meaning they're not linked to inflation. You get a certain interest rate on the bond, and that's what you get. And the bond principal never changes. If you buy a $100 bond at maturity, you probably normally buy them in a bond fund. But let's think about this in terms of just buying an individual bond. You buy a $100 treasury bond or a $100 corporate bond, and let's say it matures in 10 years. That's what you're going to get back, $100. Never changes. And whatever interest rate you get, let's say it's 1%, just to pick up a number, you're always going to get 1%. So that's a nominal bond. The risk of a nominal bond is runaway inflation, right? Because you're sort of locked in it, and you're getting US dollars back, and the amount you're getting is fixed, and inflation is whatever, sky high. That's the risk, right? But the flip side of that is, what if inflation doesn't go sky high? And what if it stays low? And so in any event, I have nominal bonds. I think an intermediate term treasury fund is a good choice. I think a total bond market fund is a good choice. I'm almost agnostic. I'll probably lean towards a total bond market fund because it gives you a little more diversity. It includes treasuries, it includes some corporate bonds, and it includes some sort of secure asset-backed bonds, mortgages, and things like that. But you could pick either one. And then the other side of that would be tips. And tips are linked to inflation. And the way that works is, your $100, so you buy a $100 bond, that $100 will go up or down during the term of the bond based on inflation. And so if inflation is 2%, that $100 goes to 102. And then it goes to 104.20 or whatever the number would be. And it keeps doing that. Your interest rate on tips never changes. Whatever it was when you bought the tip, say it's 1/8 of a percent, 1/8 of a point, which I think is what it is right now, 0.125, something like that. That stays the same, but it gets multiplied against this ever increasing balance, assuming we have inflation. It can go down as well in deflation, but at least right now, that's not what we're concerned about. And so at the end of, you get the interest on the higher principal balance as that goes up every year. And then it's say in 10 years or whenever the bond matures, you get that higher amount back. So I kind of like a 50-50. 50% linked to inflation. It could include I bonds, and I just bought my $10,000 in I bonds yesterday or the day before, but you're limited to 10 grand a year. So in terms of like an asset allocation in a portfolio, and I don't know why my hands are doing this. Tips are probably the main focus because you can buy tips through a fund. You can't buy I bonds through a fund. I bonds work differently, by the way. The principal balance stays the same and the interest rate goes up. But the thing to keep in mind is there's a tips treasury break-even point or break-even rate. Let's look at here's the Fed. So this is, I think, a 10-year. I think it's 10-year break-even. And so, what does this mean? Well, it's effectively the difference in the yield between the 10-year Treasury and the 10-year tip. And the idea is it's right now at 237. So if inflation over the next 10 years turned out to be 2.37%, then you'd end up with basically the same result with a 10-year tip or 10-year Treasury. And you say, wait a minute, Rob, how can that be? You told us tips, the principal balance goes up. So wouldn't that always be better? Well, no, because you start with a much, much lower yield. So there's a cost for that inflation protection. And it's the interest rate. The interest rate on a 10-year tip is lower than the interest rate on the 10-year Treasury. And then when the market gets involved and starts buying, they're not buying it at $100 for a $100 bond. They're paying more for tips and perhaps less for treasuries, depends. And it's that ends up changing the yield, because remember, the yield is the interest divided by what was actually paid for the bond. Hope this is making sense. Is anyone still watching? I don't even know. Okay. So the difference is sort of the market's view of what inflation will be over the term of the bond. And so that gets us to the final point here, and that is, I need to bring this thing home. I don't know which one's going to be better. If 237, if it turns out that inflation is much higher than that, tips will win, right? Because their principal balance is going to go up by more, whatever the inflation is. But if inflation turns out to be lower, well, you've basically paid for inflation insurance you didn't need, right? And I don't know which one's going to be better. And so I kind of like the 50-50 approach. And that was what David Swinson, the gentleman who has passed away but ran the Yale Endowment for decades. That's sort of his approach in his book, Unconventional Success. I also had the pleasure yesterday of speaking to Jack Brennan. He was the CEO of Vanguard from 96, I think, to 2009. He's written a great book. In fact, I've got a link to it below the video. Highly recommend this book. And I'll show it to you on the screen here. But we talked about this. Let me pull up his book. It's called Straight Talk on Investing. Here it is. Sort of a re-release. It was originally, this one was 2004, but he's actually re-released it. It's called More Straight Talk on Investing. This is the older version. Here it is. This is a great book. It would probably be in my top 10 investing books. There we go. And it's great for beginners. It's easy to understand, but I get a lot out of it too, and I've been doing this for a while. Not sure how much I've learned, but I've been doing it for a while. Anyway, I raised this issue with him. He thought that was a perfectly sensible approach. The other thing he said that was interesting, he said, the best long-term protection for inflation is actually stocks. In the short term, they can get pummeled, but in the long term, at least history shows us that stocks are the best way to protect for inflation. And of course, a lot of that looks at the high inflation of the 70s and 80s. And there was one thing we didn't have back then that we have now: inflation-linked bonds, right? I mean, we didn't have tips and I bonds back then. I don't know when they started, but 90s maybe? Not even sure. Anyway, but still, equities, and if you think, you can think about an equity like a bond, except that bonds are typically fixed principal, fixed interest rate. With stocks, they can actually benefit, depending on the company, with some inflation. Now, too much inflation throws everything up in the air, but if it happens too quickly, and in extremes, but you can see that revenues can go up with inflation. You've got to control expenses. So companies that have a lot of capital requirements, you got to replace hundreds of millions, billions of dollars in equipment. That can really hurt a business, because if inflation is really high and they're replacing all this equipment that's becoming more and more and more expensive. But in any event, they can raise, inflation can help lift a stock potentially long term. Short term, it can be a mess, and that can over time help. Their profits can offset some of that inflation sting, and dividends can go up. And so again, long term, stocks are pretty good for inflation, for hedging inflation. In the short term, I would probably just go outside and play frisbee. Actually, that's not what I would do. I'd probably play chess. Okay. All right. Scott says, thoughts. I bonds are a great alternative to park cash. No credit risk, meaning no meaningful risk of default, and hedge against inflation. Should be part of a retiree's portfolio. I agree. I just bought, as I said, another 10,000. I'm opening an account in my wife's name. She's going to buy 10,000, which I got to do like now. I don't know how long it takes. And then I'll buy another 10,000 for each of us next year. One interesting point, I was on a Reddit forum, a FIRE forum, and someone was saying, it's pointless to buy I bonds if you have a lot of money, whatever that might mean for you. But let's just imagine a $2 or $3 million portfolio for retirement. That's a lot. You're playing around with 10 grand. What's up with that? But I don't see it that way. I see it as, one, how much cash do you want to keep? And 10,000, at least for me, is a lot of money compared to how much cash I want to keep. Now, I know you can't pull your money out for a year. You got to deal with that. If you take it out before, 5 years, you pay a penalty. But given the yield, the interest rate right now, the penalty would be well worth it. But I look at it in terms of my annual expenses and how much cash I want to keep. Also, over time, you can obviously, if you're doing 10,000, if you're married, 10,000 per spouse, over time, a lot of money. So yeah, I think I bonds are a great investment right now. Probably the best risk-free investment we got, right? I can't think of a better one. So, okay. What's next? So Keith has a question about rebalancing retirement accounts. Planning to use the Merriman Ultimate Buy and Hold in low-cost Vanguard and Schwab ETFs. I'm almost 65 and planning on working one more year. Thoughts? Well, let's show everyone what that is. So let me log into, and actually good opportunity to just give you an update on my M1 Finance credit card rewards investments. I'll pull this up on the screen momentarily. The screen just went blank. I think I've lost all of my money. Oh no, here it is. So this is my credit card rewards. I take all the credit card rewards, take them to cash, put them in here. I've done this for a couple of years. 32,500. My gains this year since April, 22%. That's not bad. And right now I just have it invested in two banks, Bank of America and Wells Fargo. But in any event, let's go to research, expert pies. That's not what I want. I want my pies. Here we go. Merriman Buy and Hold. And I did a video on this. I can, after the live Q&A is done, I'll link to this. But this is roughly his buy and hold. I think he probably includes each of these in the same percentages. I forget, maybe it's a rounding issue, but there's a heavy focus on value stocks. So you see here, for example, this is an international small cap value. So there's a heavy emphasis on value, which would mean companies that are undervalued relative to their revenue and their net worth and their profits. And then a heavy emphasis on small companies. And the reason Paul emphasizes those things is because historically they've done very well. Not so much in the last decade, but if you go back longer term, they've done very well. So you can see we've got small cap value. We've got, this is sort of a developed markets value, international value. Here's another small cap, some real estate. There's S&P 500, then an S&P 500 value, another small cap value, international. So very diversified, but also very focused on small cap and value. So is that a good portfolio? I think it is a reasonable portfolio. I think there's, by the way, I think there's hundreds, I'm sure thousands of reasonable portfolios. So what do I look to? First of all, I look to low cost index funds. That's one. I look to diversity, diversification. So for me, that means both US and international stocks. I know the argument, some would say that you don't need international stocks. And I wouldn't necessarily disagree with that, except that I prefer the diversity. So I have developed in emerging markets. So does Paul in his portfolio. There's some bonds. There's, I guess it's 20% bonds. So it's, yeah. Oh, this is the way I set it up. His portfolio doesn't necessarily have to be 80-20. In retirement, I wouldn't have 80-20. I'd probably have something, for me, no more than 75% stocks. That's my personal choice. Once I'm truly in retirement, living on the investments. The only caveat to all of that for Paul Merriman's buy and hold. In fact, it's funny. I'm just remembering he left me a voicemail, and I need to call him back. He communicates by phone. He's such old school. And you say, well, Rob, I think you're old school too. I know, but it's like he leaves me a voicemail message. I don't get voicemail messages, and then I forget about it. I have to call him. It's probably too late. Anyway, you have to recognize that when you're focusing on or emphasizing a factor, small cap or value in this case, that you can underperform, say, a 3-fund portfolio over a long period of time. That's just the reality. And it's not specific to small cap. It's not specific to value. You could pick large growth or whatever. And you have to be okay with that. And so only you can answer that. I've been okay with that for a long time. My overall portfolio does focus on value. It used to focus on value through things like this, value-focused funds. Today, it focuses a little bit more on value through the individual stocks that I buy, which is why I bought Bank of America and Wells Fargo a year ago. Although I do have some small cap value as well. But you have to be prepared to underperform the market. So that, Keith, is, I think, a big question for you. And then in terms of rebalancing it, if it's in retirement accounts, obviously you don't have to worry about taxes. If you use something like M1 Finance, you just click a button, it rebalances for you. But if you have a traditional whatever, Vanguard, Fidelity, Schwab, wherever you are, in a retirement account, it's easy. You don't have to worry about taxes. Alex, Rob, can you please make a video on tax loss harvesting since it's a hot topic in December? It seems there are no clear rules on what's subject to wash sale. Like, can I switch FISVX to VIOV? Well, let's take a look. I can do the video right now. I don't know what either of those are, at least by those tickers. There are, I will say, in terms of the wash sale rule, and this is not, let me just emphasize this. This is not legal advice. It's not tax advice. I'm not an expert in either. When I've dealt with the wash sale rule, which, by the way, here's how it works. If you sell an investment at a loss, you can't have bought that same investment or substantially similar. And that's where it gets a little tricky. Either 30 days before you sold it or 30 days after, or you can't deduct the loss. And basically, the purpose of the rule is to keep investors from doing something solely for the tax benefit. Ironically, the wash sale rule doesn't apply to crypto. In the Build Back Better bill, say that 3 times fast, Build Back Better bill, Build Back, say I can't do it. they're gonna make crypto subject to the wash sale rule, but at the moment it's not. At least that's my understanding. So you could sell Bitcoin at a loss and buy it back, but in any event, I always make sure that what I'm buying is truly fundamentally different. So, for example, I would not sell a Vanguard S&P 500 fund, say at a loss, and then go buy a Fidelity S&P 500 fund. I can't tell you legally whether you could do that and be okay. I don't know, but it's like, why even flirt with that? And I wouldn't sell, say, a Vanguard. This is for sure, a Vanguard S&P 500 ETF and buy the mutual fund version from Vanguard. Definitely wouldn't do that. But I might sell an S&P 500, and I'd have no problem selling it at a loss and then buying total stock market. They're totally different investments. I mean, one has 500 investments, roughly. The other one has 3,500. So anyway, well, we can look at the funds that Alex mentioned, BISV, and I haven't had any losses since COVID, since March 2020. I did have some losses that I realized. Okay, so in any event, FISVX is a Fidelity small cap index fund. All right, and let's create another screen here. And the other one is VIOV. So it's Vanguard. And what I would do, so all I can tell you, Alex, I can't give you any advice. I can tell you whether I would be comfortable, say, selling VISVX and then buying the Vanguard fund the next day. You know, I'll just use this as an example, selling this at a loss. Can't tell you what to do. I can tell you whether I would be comfortable doing that. And the way I think about it is, I go to the portfolio. What does it own, right? And what does this fund own? And you know, if they track the same index, and I don't know if they do, I would not be comfortable. So the first thing I look at, I just look at like PE for a moment. We're going to go down to the portfolio. It's what I'm really focused on. 1257 and 1261. I'm concerned right now that these track the same thing. Let's see. Fidelity has 1430 investments. Oh, this only has 479. Okay, so it's a very different investment. And if you look at like Vanguard's top investments, Macy's at 146, 1.46 of the portfolio. Yeah, I mean, to me, I would be comfortable, just based on what I've seen here, selling one and buying the other. Now, whether I would be right or not, I can't say. Personally, I would not have any concerns doing that. Just assuming this data is accurate. But I think at the end of the day, it's always worth talking to your tax preparer if you have one. But just looking at this, they look like significantly different investments. The other thing you can look at is performance. How have they performed over time? And so for Fidelity's, well, it hasn't been around long. Year to date, it's 2457. Vanguard, 2784. Last year was 279. Fidelity was 448. So these seem to me to be pretty notably different from what I've seen. But again, that's not tax or legal advice. Have I said that I can't give you that? I can't. There you go, Alex. That's how I think through the issue. Josh, hey, Rob. I have 40 grand set aside for down payment on a home purchase 3 years from now. My wife and I put 20,000 in I-bonds, thinking of putting the other 20,000 in all-weather portfolio. Your thoughts? Well, my first question to you would be, what happens if that 20,000 goes down in value? Say 3 years from now, it's worth 15 grand. Is that going to really mess up your plans? Can you wait a couple more years? Do you have to buy in 3 years? How upset will you be? Personally, again, all I can do is tell you what I would do. If I were going to buy a home 3 years from now, and I had 40 grand, and you've already put 20,000 in I-bonds, which means you can put another 20,000 next year, assuming the 20 you got in there you put in this year, I would put it all, personally, I would put all 40,000 in I-bonds. I'd have to have a penalty. Penalty would lower it. I think it's just I think it's just 3 months interest, or that's not quite right, but it's something like that. I-bonds penalty. Bonds held less than 5 years are subject to a 3-month interest penalty. Nailed it. So, you'd obviously have to pay that, but I mean, at 7% now, and of course, the one thing we don't know is what that's going to look like over the next 3 years. It gets reset every 6 months based on CPI. So far, CPI has been high, so I would expect the next adjustable rate, which I think is like March, April, something like that, I'm going to assume is going to be pretty high, I would think. But time will tell. I personally would not put it in an all-weather portfolio. That's Dalio's, right? I can show everyone that too. For those that are saying, what's an all-weather portfolio? Part of it too, I'll be honest, Josh, is a bit of a bias. I'm not a fan of the all-weather portfolio. Here's the 2X. Here we go. If you look at it, 40% of it is in long-term treasuries. That could take a beating if interest rates go up. Now, the flip side is it could, you could crush it if interest rates happen to go down. But that's just a risk I would not be taking with my down payment for a home. And then, and these percentages, don't read a whole lot into these percentages. I don't know that those percentages, because my recollection is it was like 25, 25, 25, and 25. But, it's heavy in commodities and gold. I'm not big on that. Although, I was listening to an interview of Ray, or reading an interview of Ray Dalio, who just came out with a new book that I haven't read yet. I've read his other ones. He's still sort of a believer in, diversifying across gold and commodities. And I get that. And you can certainly do some back testing that shows that does give you some interesting diversity. He even thinks maybe a couple percent in Bitcoin. But in any event, I personally, again, Josh, you'll have to make up your own mind what you want to do. I personally would not do that. I would be very happy over the short term having 40 grand in I-bonds. And in fact, the other thing about it is, you could keep them in I-bonds for a year. At that point, you can pull it out with a penalty. And even if, let's say, interest rates crash through the floor and I-bonds are paying next to nothing, well, you get your 7%, you get whatever the rate's going to be when it's reset in early 2020, early 22, and then you could take the money out after a year, and you'd still be well ahead, even after the penalty, on any other sort of guaranteed, a savings account, CDs, So I would be very comfortable with that approach. So Ram talks about, he says, after considering IRMA, AFC, and having funds to cover taxes, I do not see any reasons for not doing Roth conversion. Avoids widow penalties, no stretch for non-spousal benefits. Okay. So I'll be the first to confess I don't follow that entire comment. But I can talk generally about Roth conversions because that's something I've been giving a lot of thought to. Here's the tricky part. There are some cases when a Roth conversion is just obviously a smart thing to do. You retire at 60, or not 60. Yeah, anytime before, say, Social Security kicks in and before your required minimum distribution kicks in. So let's just say 60. And you have no income other than maybe what some taxable accounts are producing in the form of some interest and dividends. So you're in an extremely low tax bracket, both for ordinary income and for, capital gains or whatever, but I guess mainly for ordinary income. And so you can do some conversions and the taxes are minimal. It can take you up and get you into maybe the lowest tax bracket, which is what, 10%? I don't even know. Tax brackets for 2021. We've actually looked at this page. This is from NerdWallet. They went public. Did you guys know that? I remember Tim, what's his last name? The founder of NerdWallet, when they first started this company, he reached out to me. I was running Dough Roller at the time. I've since sold it. He goes, hey, can I publish a guest post on Dough Roller? I said, sure, why not? They were nothing back then. Now look at them. They're public. In any event, enough of that. So, let's say you're in the 10 or 12% bracket. with some, in other words, you're going to do some conversions up to the 12% bracket, let's just say. And that's particularly true if you don't have any state income tax, if you're lucky enough to live in one of those states, I suppose. But it's pretty. I think the risk of making a mistake there are pretty low, particularly if you can pay the taxes out of non-retirement money. Where things get trickier, and this is true for me, is a lot of times whether a Roth if you think about what's a Roth conversion doing from a tax perspective. You're saying, okay, when Social Security kicks in and then when required minimum distributions kick in, those are two things I can't control, at least if assuming I do nothing with Roth conversions. I've got to take out the RMD. The Social Security check is coming every month, whether I want it or not. I assume everyone wants it, but in any event, and that's taxable income, right? We'll assume for our purpose, Social Security, whether it's taxable, it's a different issue, but let's just assume it's taxable. You got your RMDs. And so the idea is I will do some Roth conversions before all that happens to sort of spread out the tax liability because I'd like to fill up these lower brackets. Well, that assumes that when RMDs hit, you're going to be in a higher bracket. Well, how do you know that? Well, you have to make some guesstimates, right? I mean, in my case, we know what we have in retirement accounts. That's a fact. We can look at it. What we don't know is what they're going to be valued 15 years from now, more, 17 years from now, 20 years from now. I mean, we can make guesstimates, but when you use a Roth conversion tool, like New Retirement has one, you'll get very different results based on your return assumptions. And so that's where things get trickier. And I've talked to advisors, and in my case, it's a toss-up. And so honestly, I haven't decided what we're going to do on Roth conversion. So are there reasons not to do a Roth conversion? Sure. I mean, if you think the taxes you'll pay on it are going to be higher than if you didn't do a conversion and you just hit the RMDs, then why would you pay higher taxes? There are other factors to consider, right? At least at the moment, Roths don't have RMDs, and maybe you want to build up your Roths and give it to your children when you die. Or you're retiring early and you're going to do a Roth conversion ladder so that you can get to your money without paying the pesky 10% penalty. So there are other factors. And there you go. I see Ram sort of followed up his question. Can you think of any negatives other than the minimal chance of tax rates going down in the future? And that's the other unknown, is what the tax rates will be when you retire. And I certainly can't imagine them going lower, but they could, I suppose. Kind of hard to imagine that. But again, that doesn't mean Roth conversion makes sense. That's going to be very specific to your circumstances and your taxes. Philip said, last week you spent a while giving us your take on the possibility of bad times ahead, and I agree. However, this pandemic will probably rank high in the history books 50 years from now. Well, I would think so, right? I mean, but I can think of a lot. There are two things that I think, well, there's three things. It's trying to predict a black swan, right? And a black swan, by definition, is something that's totally unpredictable and bad, right? It's not unpredictable and good. It's unpredictable and bad. But trying to predict it anyway, I can think of three things, and I might even say four. A climate disaster, right? So, and I don't know what that would, I mean, there's all kinds of, data on what's happening and what our future looks like. And I'm no expert, but certainly a major climate event. Some could say we're having them now, but something that could really, truly disrupt life as we know it. So that's one. A major cyber security hacking event. Again, I don't know what that would look like. I'm reading a great book, by the way. I really enjoy this book. Let me pull it up for you. Really well written. And it's on my iPad. Oh, wait a minute. I've got it right here. Pull up the old Kindle. This is how they tell me the world ends. That's the name of the book. Okay, here it is. Just released, or actually, it's actually got a release date of February, but you can buy the Kindle now. I don't think the hardcover ships right now. I have it on Kindle. Really good book. So in any event, and I'm only like 10% into it. I have a feeling when I'm done, I'm going to be scared to death. So climate, cyber security. I hate to even discuss this third one. I don't even like talking about it. But you know, I've seen more and more talks about a war with China and or Russia. It's hard for me to imagine a conventional war of that magnitude today. It's just hard for me to imagine it. So maybe it would be a cyber war. I don't know. But that's a third one. I'm laughing because it's like, this is, once again, not the feel-good show of the year. The fourth one is a little different. I do think it wouldn't rank with the first three. It wouldn't, I don't think, go up there with the pandemic, but it could disrupt markets. And that is serious issues with crypto. Crypto is now big enough and there's no intrinsic value. Doesn't mean it doesn't have value. There's no intrinsic value. Ray Dalio called it imputed value. I think that's probably right. But a disruption in that sent the value of crypto falling, which we all know could happen and happen quickly. Because of the leverage involved, it could disrupt things in a pretty significant way. I don't think it would rise to the level of the other three things I mentioned or the pandemic, but it could make life not so pleasant for a while. And here's the thing. It could affect us, that either own no crypto, or in my case, I own a tiny little trinket of crypto, more just for entertainment purposes. But it could still affect us, right? I mean, it's big enough now where it would have significant effects on markets. So, yeah, there you go. So this one comes from, I'll just say, from Fran, but that's not the name. It's just a series of letters, as far as I can tell. We currently have employee-sponsored life insurance. We, my wife and I, plan to retire in 5 to 7 years. What options are best for life insurance? Well, that's a great question. And it's a cautionary tale in a way. I'm not a big fan of employer-sponsored, life insurance. A lot of employers will give you some small amount for free. Obviously, that's good. And then they'll offer to sell you more. And this is the problem. If you leave the company, you lose that insurance. So imagine you're 30 and healthy, and you could get really low-cost term life insurance, but instead you buy it through your company because, let's be honest, it's easy, right? And then you leave the company when you're 45, you still want life insurance, but maybe you're not as healthy, gained a little weight. I don't know. No judgment here. I'm just saying these things happen. And now, because of your age and your health, well, in the extreme case, you can't get life insurance, or it's really expensive. So I'm not a big believer in buying health insurance through my employer. Now, in some cases, depending on your circumstances, it may be the only way you can get it. Okay. Now, having said that, the thing that caught my eye on this question was that you plan to retire in 5 to 7 years. So my question to you is, why do you need life insurance? To me, you only need life insurance if someone is depending on your income, for support. So you're married, one spouse works, or even if both spouses work, and you've got kids, and the death of a spouse would lose the income, and you've got people relying on that income. So you have life insurance. I don't know of a single retired person that needs life insurance that I know of personally. Now, there could be exceptions if you have children who have mental or physical issues that will require care throughout their life. And I have friends that fall into that category. Although even then, whether permanent life insurance is the best answer is not always clear. And I really think you need to seek a good financial advisor. But my big question would be, why do you need life insurance in retirement? Josh, I can't answer that question. I've been to Greece, lovely, food phenomenal. Italy is high on my list as the next stop, so I can't tell you which one I would prefer. I want to go to Florence. If I could like pick one spot that I want to go to right now, it would be Florence, Italy. Super Zig wants to know if it would be wise to make early withdrawals, meaning before 59, from a Roth IRA for educational expenses. Well, so I assume you, first of all, you can withdraw Roth IRA contributions, penalty and tax-free at any time. So I'm going to assume you're talking about that. So we don't have to worry about taxes. Don't have to worry about penalty. And we're not taking out earnings. We're not taking out conversion contributions. We're just taking out plain old vanilla contributions. I'm going to assume that's the case. To me, the downside to doing it is that you have this amount of money invested. It's in a tax-advantaged account that will grow tax-free, assuming you follow all the rules. And as I've said many times, you want that account to get as fat as a tick. And so taking money out sort of gets in the way of that. So I would view it as an option of last resort personally. Now, there could be a gazillion different circumstances depending on, who it's for, the education, what value that will have, will it increase your earnings? I mean, there could be exceptions to that where it might make a lot of sense. So it's not a hard or fast thing, but rule. But it's the one downside actually to Roth IRAs. The fact that you can take out your contributions, penalty and tax free. I think it's both a feature and a bug. It's a feature, I mean, because it can help you in a pinch. But my concern has always been, will people be too quick to take the money out? Now, I'm not saying that's what's happening, what you're suggesting at all, but it would be, I would personally, if I were considering that, I would try to come up with a different way to pay for my education if I could. And I might even consider borrowing. To me, the question would be the interest rate, but assuming it's federal student loans, it's going to be a good interest rate. How much and what your education, what your degree is going to be in, and how much you'd have to borrow. I generally don't like when I hear people borrowing more than 1 times their expected annual income after graduation. That's just a rule of thumb. It's not gospel. And you have to consider what are the odds you won't graduate for whatever reason. Life happens, but so the worst, a couple of things that can really be bad. You borrow and spend a lot of money for an education and you don't get your degree. That's probably the worst circumstance financially. And that would be true whether you borrowed the money or you took money out of a Roth IRA and didn't get your degree. Not good. You get a degree that doesn't pay you nearly enough to justify the value of the education. This is the point that really gets me frustrated with both universities and colleges and our government officials. They'll haul a bank CEO in because he or she charged $35 for a bounced check. And I get why they do that. Well, why are they hauling in presidents of Harvard and Yale and having them explain why some people are graduating with mountains of debt and have a degree in English? I'll pick that since that was my degree. And they have no chance ever of making enough money to pay back that taxpayer supported loan. I don't get it. But that's a problem. So, if you're getting a degree in software engineering, it's probably going to pay for itself. Or accounting, math, sciences. If you're getting a degree like I did in English, now I went on to law school. But, if you get a degree in English or anthropology and you're going to go into debt or spend a Roth IRA to the tune of 6 figures, it's probably not a good financial investment. Maybe good otherwise. If that's where your passion is. You didn't ask me all of those things, but I answered them. All right. Fast Eddie 333 says, I have 3 college-age kids. What would you tell them to do with the money this year? Roth, brokerage account, cash? None of them have the ability for a 401k yet. Great channel, thanks. Well, if they can save long-term, to me, the Roth is, of course, they have to have earned income, but the Roth is the best. Again, we go back to the feature and bug. You can pull the contributions out penalty and tax-free, but hopefully that doesn't happen. It's growing tax-free. I'm assuming since they're in school, they're in, well, you didn't actually say they're in school. You said 3 college-age kids, but I like the Roth. And that's what I'm having our kids do who are in their 20s. So that's what I would do. And by the way, I wanted to show you this. Some would say, well, okay, but the market's at an all-time high. What are they going to put their money into? S&P 500? Yes, of course that's what they're going to do. Come on. I want to show you something. I haven't actually run these numbers, so it could turn out that I'm totally wrong. But like the theme song, the monk says, I don't think so. So what we're going to look at here is a really bad 10 years. From 2000 to 2009, we know the market was basically flat. $10,000 investment, we're going to put it all in. We'll put it in VU, which is Vanguard's S&P 500. And after 10 hard years, what did we have? VU doesn't go back that far. Figures. I may have to go to, let's try SPY and see if that does. And if not, I can do this another way. There we go. 2000 to 09, it's 10 years. Look at that final balance. That's why they call it the lost decade, right? So imagine you're a college-age kid. Are college-age people kids? Anyway. And we live through this same kind of year. If someone said, well, what's the next 10 years going to look like? I mean, this is very plausible, right? My goodness, sure, given the valuations. But of course, they don't have 10,000, right? Let's assume they've got $1. And they're going to put in, we'll say $250 a month. And we'll adjust it for inflation. So that's what, well, that's actually not adjusted for inflation. So there's $250 a month. So that's what? That's $3,000 a year for 10 years. So it's $30,000. That's what they're going to put in, 30,000. And remember, this was a lost year. Lump sum actually went down in value. And this one went up. Now, it's still a relatively small number, but of course, we're only putting in $250 a month. But it actually went up. We can ignore this for the moment, but it went up to 32,000. And the reason is because as the market goes down, they're continuing to buy each month. They're buying in bad markets. So the tech bubble bursting in 2000, 2002, they're buying. 08, 09 crash, they're buying. They're buying in up years too. So if you're young, you want the market to crash. I mean, if you're 20, 30, 40, you're hoping the market craters. You are. Now, if you're like me and retired or near retirement, you might have a different view of what you hope happens. Okay. Krishna, question on portfolio allocation. How should I factor for the value of my primary residence, no mortgage, into the percentage allocation to real estate in my overall portfolio? Excuse me. So my personal take is I don't factor it in at all. Obviously, I track it in our net worth statement, but I have 10% allocated to real estate, and for me, it's just in a REIT. I don't factor in, I don't view our home as an investment. Now, if I owned real estate investments, properties that I was renting out, that might be a different story. And I probably would include that in, say, real estate allocation. But my home is just not an investment. History tells us that real estate basically goes up by the rate of inflation. Obviously, depending on where you live, it can have wild swings up and down. That's particularly true if you live in an area that's dominated by a single industry. So Texas, for example, in the oil booms and busts, you saw real estate go up, go down. Same thing with, say, the Detroit area. Particularly back in the golden days of the auto industry, there rises and falls. But I just don't view my home as an investment. Eric says your mic keeps cutting out. Well, I don't know what in the world to do about that. I will test it over the week. Sorry about that. It might make me sound more intelligent. I don't know. But I'll have to test that. I don't know why that is. Remember, if you're joining, if you didn't start at the beginning, if you want to ask a question or have me talk about a topic, tag me in the comment. Steven says, Rob, I was thinking of spreading out our Roth conversions over the year with sort of an opportunistic approach. We have a good grasp on our yearly tax situation moving forward. Thoughts? Well, by opportunistic, I assume you mean do the conversions, I guess, when the market is down. I'm guessing that's what you mean. The problem with that, from my perspective, is, again, it's kind of a market timing. It's not, the worst thing in the world, but yeah, I just don't know. The market goes down 5%. I guess it could fall further. I suppose you could convert more. I assume you have in your mind how much you're going to convert in total for the year from a tax planning perspective. So if it makes you feel comfortable to do it that way, I don't think it's the end of the world. You're talking about a relatively short period of time. I could see maybe doing it on a quarterly basis. The thing is what you hate to do is convert when the market's up and then it crashes and you could have converted at lower prices and all that sort of thing. But I generally avoid investing decisions that are based on how the market is doing at a particular time. I've just not been good at it the few times I've tried it. John wants to know, what are your 3 top investment books, must reads? That's a great quote. My book, Retire Before Mom and Dad. I've got to mention that one. But that's not a pure investment book. So I think I can't say that I have a top 3. I can tell you though what would make generally a short list. So the one I mentioned, More Thoughts on Investing. Is that the actual title? More Straight Talk on Investing. I think it was a really good book. I like the Boglehead's book on investing. It's a good one. I like Rick Ferry's All About Asset Allocation. I can show you these. My friend Rick Ferry wrote this one. So if you're new to asset allocation, this is a good book. The Bogleheads Guide to Investing is a good book. One that I enjoyed back in the day, it's been a long time since I've read it. It's The 4 Pillars of Investing by William Bernstein. It's a good book. For bonds, I mentioned this book. The bond book, I think, is probably the best for just understanding how bonds work. So yeah, I bought it. I bought an old version, or not the older version, and then I bought there was an update, which is what you're looking at. I bought that this year and read it. That certainly is a good start. I think if you're interested in investing in individual stocks, whoops, spell Mr. Buffett's name correctly. Things like the Warren Buffett Way, an excellent book on understanding value investing. I read The Snowball, but that's more of like a biography. But the Warren Buffett Way is excellent. Actually, The Intelligent Investor by Ben Graham is, again, sort of considered like the Bible of value investing, one that Warren Buffett mentions quite a lot. So those would be good if you're interested in investing in individual stocks. And it's kind of, I try to think that's my approach to investing in individual stocks, whether I actually accomplish that. Alex, can you rate 3 best financial companies to open an IRA? That's a great question, and I'm actually working on an article and probably will do a video. So I've been thinking a lot about this. So I will tell you what I think are the best. There can be reasonable differences of opinion. I really like, for just your sort of standard brokerage, I really like Fidelity. There are physical locations, customer service is excellent. They spend probably more on technology than just about any other broker out there. They have low-cost index funds. Obviously Vanguard does, and BlackRock and Schwab. There are others, but they have excellent index funds. They have good tools. You actually, they call it Full View, uses eMoney Advisor technology. Doesn't give you all the features of eMoney Advisor, but it's pretty good. They have, particularly as you get to retirement, they have good cash management. There's a debit card. Of course, they have a credit card. They have cash management accounts. They have bill pay. You could use Fidelity. You wouldn't even need a bank. You could just one-stop shop. Now, having a bank is fine, and you can transfer your money from Vanguard to your bank, for example. It's not a big deal. But in terms of what I would think of as traditional, I would probably rank Fidelity pretty high. I think if you're high net worth, think, I don't know, millions for sure. I like Schwab because they have a lot of things that cater to high net worth individuals. Things like pledged asset lines, something I don't think most people need, but some people want them. And it's different than a margin loan. It's not borrowing to invest. It's borrowing to take a vacation or upgrade your home because you don't want to sell assets and trigger capital gains kind of thing. But Fidelity, I think, for most people is pretty good. If you want a robo-advisor, and Fidelity has its own sort of robo-advisor, Fidelity Go, and Vanguard has them. Has a digital advisory service. So there are other options, but for the robo-advisor, I really think Betterment is really good. They just have a lot of features for retirees, for general investors. I followed them from when they launched. I met John Stein at a conference shortly after they launched. This was 10, 11 years ago. I don't have any accounts at Betterment. I have in the past. I haven't for years, but I think they're good. If you want, and then the third one I'll mention is if you want sort of some of the benefits of robo-advisors, but you don't want the fee, M1 Finance is a good option, right? Because there's no fees. You pay the fees of any underlying ETFs that you own, but M1 Finance doesn't add fees to it. And you can rebalance with the push of a button. So if you want sort of some of the robo-advisor benefits, but not the costs, I think that's a good option. So there you go. There's a few. So just again, a reminder to tag me if you want me to cover a topic, because normally I skip over your questions, but I see one that didn't tag me, but is a question for me from Paul. I have a question. That's why I saw it. See, I am down about 26% because I bought into the hype of ARK. Well, we were just talking about ARK. I'm looking for an exit strategy to get out of ARK because I no longer support it. I can hold it for as long as needed. Well, I don't think of it in terms of an exit strategy, Paul. If I'm in an investment that I don't think is a good investment, I sell it. That's the exit strategy. I suppose you said you're down, so there's no worry about taxes from a gain perspective. And if it's in a taxable account, you might have some losses. So you might think about, do you want the losses in this year or next, since we're in December? So there could be some tax considerations. But I'm not thinking, well, should I hold on because it might go up? I mean, it might. I don't have any insight into that at all. So you could sell today, and then it could go up over the next whatever, week, month, 3 months, and you could be very upset with yourself. What I would personally do is I would evaluate what my investment, what my plan is going to be. Why did I buy into the hype? How can I prevent myself from doing that in the future? And what's my plan? And let's say your plan is a 3-fund portfolio, or you add some emerging markets or some small cap, or whatever your investment plan is. I personally would figure that out first. And, literally that can take a couple of minutes, or maybe you need to think about it. Maybe you need to read a book. I would figure out what I want to do, and then I would do it. And if that included selling ARK, then I would sell ARK. That's how I would do it. Double Dog Blitz, do you think the CPI is accurate, Consumer Price Index, or does it understate inflation? Yes. I mean, it's accurate for what it measures. Does it represent the inflation you experience or that I experience? Probably not. But is it a rough estimate of where prices are going? Sure. It's just, I mean, I understand I've read a lot about the different criticisms over the years. But at the end of the day, what matters to you and me is the inflation we individually experience. And it's certainly going to vary. It's not going to track the CPI. All right. Neil, any thoughts on investing in Rivian? Rivian is building a massive factory in Georgia. So Rivian is an electric car company. Let's see if we can, which I misspelled as I typed it into the Google machine. Here it is. I think, why are we looking at mountains? There we go. And this is pretty cool. I guess that's an SUV, right? They've got the truck. This is sort of, I think, what they've been most promoting. Yeah. And but is it a good investment? Well, here's the problem. I don't even have to look at the financials. We can do that. Here's the problem with investing in Rivian. And I'll pull up some financials in a second. Without even looking at the financials, of course, we know they're not making any money to speak of. So they're losing money. They have to be. We'll look at their income statement here in a second. But I'm going to assume they're losing money. And they're entering in a market that's already dominated by Tesla for the moment. But they're also entering in a market that will soon be flooded with competitors, including big three, big five, whatever auto companies. And so I think it's almost impossible with any degree of confidence and to project what the profits of this company will look like, say, over the next 10 years. There's no way to do it. And if you can't do that, and by the way, that's true of a lot of companies. This is not just a problem with Rivian. If you can't do that, and this really is, I think, some of my criticism of ARK and the investments they're in. If you can't do that, if you can't attach a reasonable valuation to the company. Now, that doesn't mean it doesn't have a value, and that doesn't mean it's not trading, and that people are trying to do that. But at the end of the day, you can't. And so if I don't have confidence that I have some idea of the value of something, how do I know if I'm overpaying or underpaying? I don't. So in my mind, it's not a good investment. Now that doesn't mean that you couldn't put whatever 10 grand into it today and make a fortune. You might. And people make fortunes investing in all kinds of things that they can't possibly value. And so if I were going to invest in Rivian or that for that matter, just about any electric car company, it would be the kind of thing where it'd be a relatively small amount and I'd just be, this is just a long shot, which I don't normally do. Okay. Now let's look at their financials, and for all I know, they're making a fortune in profit, but I don't think so. So here we are. I'm on the Rivian website. We're going to look up their SEC filings. So they've taken us over. I don't know if you can see the URL, but this is now the SEC's website. Edgar is the name of their database. And these are all, we've talked about the different types of filings. Oh, staff letter, maybe in response to their S1. So I don't know if this S1, so S1 is what you file when you want to go public, you want to list your shares. Here's an amended S1. It's amended, you see that because you see the A down there. Anyway, doesn't really matter. We'll just use this. So here's the date. It was just filed not long ago. And I want to just look at their financials. Normally they have like hyperlinks. We get a lot of pictures. Why do we have a picture of Prime? Are they selling stuff to Amazon? Anyway, here we go. So normally, sometimes they put it at the end, but we'll, sorry if this is giving you a headache. Well, this is not their income statement. This is sort of a summary, right? But you notice it's results of operations, right? That's just a fancy way of saying income statement. And when I first looked at it, I thought, well, wait a minute, this isn't right. They're starting with their expenses. You start with revenue. Well, they don't have any, at least not for the periods, for the periods ended December 31, 19 and 20. And for the 6 months ended June 30, 2021. So, they're losing money. And you would expect that. I mean, it's an early stage startup. And, you think about venture capital, they're investing early stage. Companies aren't making money and people become billionaires investing like that. It's not a competence that I possess. So I would not view Rivian as a sound investment for kind of those reasons. We could certainly dig into it and come up with a theory. They can sell X number of cars and this will be their margin, but we're really, really guessing. And but people will invest in it and some people will make a lot of money. So there's the answer. The thing about being a value investor is you watch other people making lots of money. That's what you do, at least for a period of time. Viv says, we just sold an investment property and have about 200,000 in profit. We are about to retire in 4 years. Where should I put it for safety and for it to give me some income? Dividend ETF, question mark. Well, that's always the trick, right? We want it to be safe, but we want it to produce for us. So the way here, all I can tell you, Viv, is how I think about this. In my case, I would take the money and put it into my overall asset allocation plan, which means some would go to, an S&P 500, some to small cap, some to REITs, some to emerging markets, some to developed countries internationally, some to bonds. I would treat it like I've treated all of our other investments. And but that's not necessarily the right answer for everybody. You say you're going to retire in 4 years. My questions to you, some things to think about. Well, what other assets do you have that you're going to live off in retirement? Or is this it? Do you have other investments? Do you have other real estate? What do all of those things look like? And what is your plan for all of those other things? And why not just, if it's a solid plan and one you like and it's reasonable, why not take the 200,000 and deploy it in similar fashion? There may be reasons not to, but these are just questions, things to think about. When you retire, and how old are you? Are you 65 retiring in 4 years, or are you 35? That's going to matter. When will you need to spend the money? You're retiring in 4 years, but you may, even if you're retiring at a traditional age of 65, you may be planning for a 30+ year retirement. So you're still a long-term investor. Yeah, you might need to start spending some of the money in 4 years, but presumably you're not going to spend it all, in 4 years. So, these are all sorts of questions. In terms of the bigger question, where can you get safety and dividend or yield income? That's hard. You certainly can invest in a dividend, what would be considered a dividend ETF. One of the ones that I like is Schwab. And I'll pull it up in a minute here. Here it is. Whoops. SCHD is the ticker. It's only 6 basis points. Its yield right now is, why am I missing their yield? Yields. So around 3%. The thing though, the caveat to all of that would be, it can still lose a lot of value. If stocks go down, it will lose value. It'll go down. So don't view a dividend ETF as something that can't lose a lot of money quickly, because it can. And in fact, if we look at it in Morningstar together, so here I am, this is the same ETF in Morningstar, and we look at performance. It's had a good run. It lost 5% in 2018, a little in 2015. Other than that, it's had positive years, really good years. Of course, the market has had really good years. So you have to keep that in mind. The reason it's had good years, it may be a great fund, and I think it is a solid fund, but it's had great years in part because the market has had great years. So if the market tanks, it could tank too. So I don't know how much that's helpful. I think at the end of the day, the starting point is what's your plan for your money in retirement, not just the 200, but all of your investments. Your plan for Social Security. Are you going to, you're going to retire, but we have other sources of income. Do you have a pension? Will you work part-time? And then depending on how much you need to draw from your investments, generally, if you follow something close to the 4% rule, you want equities of 50 to 75% based on Bill Bingen's analysis in 1994, which I think is still generally a good rule of thumb as a starting point. The best flexibility is to spend less than 4%. And be willing to forego inflation adjustments if inflation gets out of control. But that's a whole different topic. All right. Here's an interesting question from Vinyl. Would selling a cap-weighted S&P 500, which is a standard S&P 500, and buying an equal weight, so one that invests an equal amount in each of the 500 companies, would that be okay from a wash sale rule? So again, not a tax or legal advice here, but I would think so, and I'll show you why. So we'll first pull up. Let's see what we've got. We'll first pull up, we'll just use VU, which is an S&P 500, and then I need to find an equal. I think ProShares does one, right? Equal weighted S&P 500. Invesco. What's the ticker? RSP. I knew it began with an R. So if we go to portfolio, you'll see they're totally different. So the S&P is going to be a blend large cap. See right here, that's sort of when you do a weighted average of all their investments, they're primarily large companies with a blend of growth and value. Equal weighted, go to the portfolio. Look, totally different. It's on the cusp of value and mid cap. It's price to earnings, very different. Here's S&P. And if we go down to the portfolio, of course, the top investments are all known to us, right? No surprises there. But for this one, I mean, it's all basically around 30 basis points, and the top ones are different. So, yeah, I would personally, I can't give you advice, but I would personally not have any trouble going from one to the other. I wouldn't do that, by the way, because I think they're totally, actually, I wouldn't do it because they're totally different, in my view. I'd go to a total stock market, but that's just my approach. Again, if you've joined a little bit late, remember, if you want me to talk about a topic, please tag me in your comment. Would it be better to pay extra or invest the same amount in a 5-fund portfolio when working towards paying off a low APR mortgage? And Brian asked this question. So there are always a couple of things that I put as a priority ahead of paying off a low rate mortgage, or for that matter, low interest rate debt beyond that. But so I want to max out a 401k. I want to max out an IRA. If I'm saving for kids' education, child's education, want to max out, 529, and beyond that, just save for their education. If I have an HSA with a high deductible healthcare plan, I want to max that out. And then once I've done all that, I want to make sure I have plenty of liquidity, right? So an emergency fund, fully funded, whatever that is for me, 3 months, 6 months. I would probably be on the higher end of that, maybe even as much as a year, but that's my own personal preference. And then, of course, I'd pay off all non-mortgage debt, I think. I mean, there could be an exception, like if you are trying to get a forgiveness of a student loan, you got 10 years, you're a teacher or whatever, you might not pay that off. But barring some reason not to like that, I would want to pay off all other debt before I paid off the mortgage or started paying extra on the mortgage. The other thing I would do is I would make sure that I had future, I'll call them capital expenditures saved for. So if I know I'm going to need a car in 3 years, I want to make sure I've got that covered too. Because if I don't, and the 3 years comes around and it'll happen faster than you think, now you're borrowing for the car. So the money you paid off on the mortgage is now ended up as a car loan. I don't want that. So I want to make sure I've saved for my next car. I've saved to replace the roof if that's coming up, or the furnace or whatever. So these sort of capital, in corporate world, they call it CapEx, capital expenditures. I want to make sure I have that covered. And that's basically what we did. And then we started paying off the mortgage. So that was my approach. I think it's reasonable. Probably not the only reasonable approach. Richard, what are the best types of assets to keep in a Roth IRA? I'm 27 and have maxed out Roth for 2 years. Well, first of all, congrats on maxing out the Roth. And I'm really parched today, so you'll have to forgive me while I take a drink. Well, I like the Roth, as I've said, to get as fat as a tick. So assuming I've got a well-diversified portfolio and I have investments in traditional accounts, Roths, taxable, and I have a choice, because if a Roth is the only thing you have, then I'm still going to do some sort of diversified portfolio, or maybe a 3-fund portfolio, whatever it is that you choose, it's going to be in the Roth if that's all you have. But if you have other types of accounts and you can choose what to put in a Roth, I'm going to put assets that I think have the highest expected return. So small cap, emerging markets, certainly stocks over bonds. Ankit says, what percentage of your monthly investments are you comfortable putting in individual stocks? Well, I didn't think about it in terms of monthly investments. I thought about it in terms of total portfolio. And at the time when I first started, my answer was like 5%. Part of the reason was I hadn't done it before. This was, I don't know, 10 plus years ago. And I was concerned that I don't know what I'm doing. That eventually went up to about 10%. Now, the problem is that my investments did really well. And as a result, they now represent a much bigger percentage. I talked about this last week. And I'm just pulling it up now so I can tell you what that percentage is. Yeah, almost 26% of our investments are in 4 stocks. I don't recommend that. I really don't. And it's probably too much. I'm not selling at the moment. And there are a variety of reasons that maybe make our circumstances different than others, perhaps. But I'll probably lighten that load in some way. The problem is I have to factor in taxes. And it's just not pretty, no matter what I do. So to me, 5%, 10% is smart. The question, though, is if they go up in value, if you do a good job, or you just get lucky, and I don't know which one accounts for me yet. Maybe it's a little of both. Do you start selling because they've done so well? I mean, some would say yes, but these are not companies that I think, they're not fly-by-night companies. I mean, should I sell my Berkshire stock? Apple, maybe Apple. Some would argue it's at all-time highs, so maybe. But it's also cash cow. I wouldn't recommend 25%, though. And I need to figure out what to do about that. I don't know. Is it wise to pay off your mortgage at 4% or invest that money? So I've kind of given you my take on it, at least what I would do before I pay off the mortgage. I think it's perfectly reasonable to not pay off a low-cost mortgage and just dollar cost average your money into a diversified low-cost portfolio. I think when you get to that point where you've ticked off all the other things I mentioned a minute ago, and now you're down to just, should I pay off the mortgage or invest? assuming you're investing long-term, low-cost, well-diversified portfolio, it's hard to go wrong. Either one is reasonable. Vinyl says that he went to Yale grad school in the English PhD program and then became a computer programmer. So your English degree paid off, I'm guessing. Felix says, by the way, my chat scrolled all the way down, and man, I got a ton of questions to answer. I'm like way behind. Out of curiosity, what's your view on the energy sector? Is it worth investing in oil companies or not worth, with green being the future? I think that a lot of money can still be made in the energy sector. And I understand where we're moving to, or hopefully, I guess. But in the meantime, I still think there's a lot of money. I mean, that's not a prediction of what the market's going to do short term. I have no idea. But you can get a lot of good value stocks in the energy sector from time to time. And I still think, we're a long, long way from not putting gas in our cars. So I do think that the energy sector has the potential to produce a lot of returns over, I don't know how long, a couple of decades, or maybe longer, but. Dan says, if you do take contributions out of a Roth, can you then put them back in? How do the annual limits play into this? Let's say you take out 10K and then want to put it back. So there, at one point you could recharacterize. And then I think there was a change to this. Like with the conversion. Well, if you take it out, you're saying take it out. You take it out. So you have, yeah, okay. So if you withdraw from a Roth IRA, so what I was referring to, and I may have misunderstood your question, is let's say you convert a traditional to a Roth, you could recharacterize that. But if you put money into a Roth IRA and then take it out, can you then say, oops, I want to put it back in? I don't think you can, but I'm not positive. And here's a good article that might answer the question. I won't take the time to read it, but you might start here. Vanguard, if you just Google Vanguard IRA recharacterizations. So there are possibilities. I just don't know if they apply specifically to what you've described, but this should probably answer your question a lot more intelligently than I could. So Mark says, low-cost index funds, their short-term and long-term capital gains passed on to investors seemed much higher than expected. And he lists a few funds. Do you know why this occurred? So mutual funds can pass on to you capital gains even if you've never sold, which is one of the benefits of ETFs. Now, Vanguard figured this out with mutual funds. So the mutual funds I own at Vanguard haven't paid out a capital gain in as long as I can remember. I mean, I don't know when the last time was. But this can happen based on buying and selling inside of a mutual fund. So it can happen, and that's why you've got to be careful, particularly when you buy in December, because this is when they get distributed, or a lot of it. The specific funds, though, that you mentioned, I don't have any. We can look one up. I'll pull this up on the screen if I find something. They're all Schwab funds. So here's the total stock market index. This is one of the ones he mentions. And yeah, if you look right here, I don't know how well, let me see if I can make this a little larger. So Fidelity does a great job with their data on funds, I think. And we're looking specifically at the fees and distributions tab. And you can see, sure enough, they, 23 cents, 24 cents was distributed as capital gains on 12/10, right? Now, this is the total stock market index. If we go to let me just see if I can put it right in here. Let's see if this will work, because this is Vanguard's total stock index. What happens? Oh, that happens. Let me see. Oh, here we go. Fees and distributions. See? Nada. They have dividends, of course, but no capital gains. So yeah, I mean, if you're going to invest in a mutual fund, even a low-cost index fund, you need to take a look at that. And my view is Vanguard is the best. Fidelity, I don't know what their ticker is for their total stock, but let's see. They've got a link. I could just Google it. Let's do large blend. 7 funds. What do we got? All right, hang on. Fidelity total stock market. I think I've actually invested in this, so I should know the ticker. FSKAX. Pull it up and see how they've done. I'll show you on the screen here in a second. All right, here it is, fees and distributions. I thought they solved this problem. Well, you can see they've paid some, but not since 2019. Of course, that doesn't mean they're not paying any now. Don't know yet. So yeah, I mean, it's a risk. It's something you need to think about. I don't know if, Mark, I'm not sure how much that helps you, but yeah. At one point, I think Vanguard actually obtained a patent on whatever they do to keep the mutual funds from paying capital gains. And maybe that's going to expire at some point. I don't know. I researched this at one point. Scott says, thoughts on the current Fed deficit. Seems that no party is serious with addressing this serious issue. Reminds me of the roaring 20s, only a crash will generate attention. I can't disagree with you. Politically, in fairness, we can blame the politicians, and I think you can look at both parties, but at the end of the day, if we had, let's say, a president said, you know what, by golly, we're going to really cut back and we're going to attack that deficit, we're going to raise taxes, and on the rich, sure, but the middle class too, because the rich can't pay for everything, and even if we took every dime they have, we're going to raise taxes and we're going to really just fight this deficit. They wouldn't get elected. They would lose. So I don't, we can blame ourselves, I suppose, collectively. What will ultimately cause us to act is circumstances beyond our control that require us to act. That's my view. I don't even think that's pessimistic. In some ways, it's human nature. So Martin says, anything wrong with the iShares allocation ETF? So we actually looked at these last week. They're very similar to Vanguard's life strategies funds. I think they're good. We looked at, let me pull it up on the screen here. We'll just, we looked at AOA, which I think is an 80-20 fund. Low cost, 15 bips. Portfolio, I think, is 80-20. I could be wrong. Yeah, 80-20. So that's US, that's international, that's fixed income, and some cash. These look like good funds to me. You've mentioned a couple others. I'm guessing they just have different stock bond allocations, but I'll pull one up. AOK, gotta like that one. AOK. So again, 15 bips. Portfolio. Yeah, so this one's heavy on the fixed income. And if you go down and look at what they're actually investing in, it's going to be other funds, mainly, well, iShares, I guess, yeah. Did I say Schwab? Anyway, iShares. So, yeah, they seem pretty solid to me. I've never invested in them. Grace wants to know what I think will happen to inflation rates given the news of the plans with the Federal Reserve. I'm interested in buying an I-bond for the long run. Well, I like I-bonds. I think they're a good investment right now. And even if I ended up selling them a few years from now and taking a 3-month penalty, I think they're going to be, given their rates, a pretty good place to park some cash. I don't know what inflation rates will do. The interesting thing is this. So the Fed needs to fight inflation. I mean, they can allow it, as they have on a relatively short-term basis to go certainly well above their 2% or 2% plus benchmark. We all know that, but they can't let that happen indefinitely. And in fact, we know they're not. They're tapering. They're going to end their bond buying program next year, early next year. They're going to start raising rates. At some point, they could be selling bonds back into the market, which then sucks cash out of the economy. The problem will be if it gets to the point where we start paying a lot of money on our national debt, right? New bonds that get issued as old bonds mature, we need to roll them over. That could cause us to have to make some very tough decisions as a country. And right now, politically, we're not well positioned to make those tough decisions because, and I don't want to get into the politics, this is my view, that both parties have elements that are on the extremes, extreme left and extreme right. That's not unusual. I mean, that's normal. I'm reading a biography of every president. I'm on Monroe at the moment. I also read Hamilton. Obviously not a president, but significant political figure. I mean, they were as partisan and nasty. I mean, brutal back then. I mean, it was really eye-opening for me. So we have that, but I think we have it in some ways in an extreme. And it makes it, as we've seen, I mean, the Republicans, whether you think this is good or bad, wanted to get rid of the Affordable Care Act. They couldn't. The Democrats, they want to get back the Build Back Better plan. But at least right now they can't. And they probably eventually will, but it'll look nothing like what a lot of them wanted. So even when you control, and I guess it's, they don't really control the Senate because of the filibuster, but still, you've got a pretty significant control of the House, the Senate, and the president, and the White House, and the Republicans had that, a few years ago. It's hard to get things done. So we're not at the moment well positioned to make some of the tough decisions. Now, some would say though that's actually will allow us to make decisions that are more middle of the road, and that's the best way to go. So maybe it'll work out. I don't know. But having said all of that, I like I-bonds. I just invested in them. Danny says, your gold frame is at risk of falling behind you under the lamp. That's my lovely wife. You're right. Thank you. That's funny. So that back there is when I worked at the Public Company Accounting Oversight Board. That's not a Red Sox jersey. That's a PCAOB Sox software jersey. This is an ugly piece of art that my dad purchased in the 70s. That's a picture of me and my father, which you can't really see. To the left is a PCAOB signature board when I left the Enforcement Division of the Public Company Accounting Oversight Board. And below that is a picture and scorecard when I got a hole-in-one, the only one I've ever gotten. And I had a witness, 190-yard par 3, hit a 5-iron. Great. I think I still shot like 104 for the day. No, wasn't that bad. All right. Thank you, Danny. Appreciate that. See, now that's the kind of support I need from you guys. You need to be telling me these things. So Jim says he's buying a car. Number one, should he use, I guess, IRA, some kind of IRA to withdraw and pay in full? It says BENE, Benny. I don't know what that means. Is that what am I missing? What does that stand? Beneficiary IRA. So inherited IRA, maybe? Should I use an inherited IRA to withdraw and pay in full? I'm going to assume it's an inherited IRA. Use an inherited IRA for down payment only. Use an inherited IRA to make payments rather than using as part of a monthly budget. Well, so my first question would be, why not pay cash? And if your answer is, as I'm going to guess, I don't have the cash, then I would say, why are you buying the car? Now, at that point, you're saying, Rob, come on. Don't go all Dave Ramsey on us, really. We want to watch him, we can. Yeah, I get it. But I do think there's something to be said about figuring out a way to do stuff without taking the easy road. And so, it might mean buying a car that you don't really like, but it gets the job done. Long term, you'd be better off. Now, you might say, okay, Rob, appreciate that, but that's not what I'm going to do. Well, the thing about an inherited IRA, and I'm assuming, I'm assuming it's inherited IRA, and I'm going to assume it wasn't left to you by a spouse, because if it's a spouse, you can then bring it into your own IRA and treat it just like a regular IRA. With an inherited IRA, you either have to take the money out, and this is subject to some change. I think there's some legislation on this, but like I have a small inherited IRA, and I could either take the money out over 5 years. Of course, I get taxed, but no penalty, or I can basically do an RMD. So I chose an RMD because I didn't need the money, and why incur the taxes? So if I could get a car loan, like at 0% interest or something like that, I might just it depends on what the RMD would be. Will the RMD cover your monthly payments? Depending on the size of the IRA and the size of the monthly payments, but I'm guessing unlikely. But again, it would depend on those factors. The point I'm making, though, and artfully, I might add, is that I want to keep my tax liability as low as possible. So it would just depend on the numbers. I also don't know your age. Are you retired? Are you working? There's a lot of other factors. But yeah, I don't know how helpful that was. Philip, how about your favorite books non-investing? Well, I have to be honest, and I am a Harry Potter fan, and I am a Lord of the Rings fan. Those are both the kind of books that I could just read every couple of years. I like the Grisham kind of stuff. Oh, I'll tell you who probably my favorite storyteller today is Stephen King. Phenomenal storyteller. I don't like all of his books, and some of them are great until the end, and they just have weird endings. He gets all metaphysical or something at the end. But in my view, there is no better storyteller today. The dialogue in his books is just, and the way he can create a character out of what the character says and how they say it is, to me, phenomenal. Nothing better. Dwight says, can you put the reading list in the comments? I assume you mean the investment books, and I'll do that. If I remember, I will put them below the show notes when I'm done. So Paul says, to follow up on my previous question, can I sell off ARK at a 26% loss and tax harvest some of my income, then use the funds I have left over to open a Roth with 100% VTI? Well, so I'm assuming the ARK investment's in a taxable account. If you sell it at a loss, you will have, capital loss, whether it's short-term or long-term, depends on how long you held it. That can be used first to offset gains that you have this year. And then if you have still some losses left over, you can offset up to $3,000 of other income. And then if you still have losses left, those would carry over to next year. And then can you open a Roth? Let's start there. Well, you have to have earned income, and you can't have too much. We can look at the Roth income limits. Here we go. Looking at this is Schwab. This is single filer, married. It phases out, but assuming that you don't exceed the Roth IRA contribution limits in your income, you have to have earned income, equal to what you're contributing. If you don't have a job, don't make any money at all, you can't contribute to an IRA. But in any event, I'm assuming that's not the case. So there's your income limits. Assuming you're under those, yes, you can open up a Roth IRA. And yeah, obviously you could invest in VTI, which is Total Stock Market Index Fund. And of course, you can only put, you see your contribution limits here. By the way, you notice the limits are getting lower. That's as your income goes up, because you don't just lose the ability to contribute to a Roth IRA if you hit 198,000 as someone married filing joint. And keep in mind, it's not your income, it's your modified AGI. But in any event, as that goes up, what you can contribute goes down until you get to the bottom, and then it's at zero. So it's gradual. Hope that helps. Anita says, great channel. I have about $45,000 in student loan debt and I have $5,000 saved. I wanted to start investing, but I believe I should pay the loans off ASAP. What do you think? Well, questions. I guess I'll ask you questions. What's your interest rate? Are these federal student loans or private or both? Do you have any income, any student loan forgiveness in your future? Because of your job, what you're doing, or the programs, the different repayments that are available to federal loans. If you did focus just on paying off your student loans, how long would it take you? Which is another way of asking, how long would you not be investing? It's one thing if it's going to take you 6 months or a year, fine, knock it out if that makes you feel better. But if you say, well, it's going to take me 5 or 10 years, then the question I have for you is, does it really make sense not to start investing over the next decade? Do you have a 401k or other workplace retirement plan? And does the employer match contributions? Another important factor. So you have all of these things to think about. My approach generally is, assuming the debt is relatively low cost, the interest rate is relatively low. I'm going to assume, since it's a student loan, that it is. I tend to prefer investing. I know that's not the Dave Ramsey approach. I don't like to hold off the power of compounding. Now, having said that, another thing to consider is it doesn't have to be all or nothing. You could start investing some and paying extra on your student loans with the rest. You could do a little of both. That's okay. I can see I'm almost out of time. I'm trying to get to all your questions, but I won't make it, and I'm sorry. I won't even come close. So you know what I'm going to do? I'm going to do another live Q&A, except I'm not going to take questions from the chat. I'm going to respond to questions that have been emailed to me or questions in the chat that I didn't get to. I don't know when I'll get that out, next week. Oh, and next week, there won't be a live Q&A for chat because of the holidays. I should tell you that. Should I consider customer service when considering brokerages? I think so. This Ram asked this question. I mean, long periods of time can go by when you don't need to call them, but when you do, you want them to answer the phone. And you point out that M1 and Vanguard have the worst customer service. I don't have any experience with M1. I will tell you, I'm a big Vanguard fan. You all know that. But there's an interesting article that I'll show you. It was published on Morningstar. As Vanguard lost its way. It was just published a day or two ago, a couple of days ago. And one of the things that they bring up is customer service. I asked Jack Brennan about that, whether he thought, not just customer service, there are other issues mentioned in this article, whether he thought some of the criticisms of Vanguard were fair. His view was, he said, look, I've been around Vanguard for a very long time, and we've been criticized, for different things over different periods of time. And by and large, whenever you're as big as Vanguard is, you're going to take on some criticism. But by and large, he doesn't think it's well-founded. I guess time will tell. I will say, and like I said, I don't have any experience with M1's customer service. I do have experience with Vanguard's. I will say that for me, I have found Fidelity's customer service, and what I have mainly there is 401ks. I found their service to be excellent. They answer the phone. I mean, Vanguard answers the phone too. This isn't really so much a comment about Vanguard as it is, I've found Fidelity's customer service to be really, really good. Others could be great too, but. Flying Doctor says, what's your opinion about VDHG? Let's look it up. Or it's not V, F. No, it's V. VDHG, is this Vanguard Fund? I'm not finding it. Oh, it's Vanguard. I don't know why it's not Morningstar. In any event, we'll look it up on, that's weird. It's not even coming up for Vanguard. Oh, here it is. Oh, this must be, here it is. This might not be a US fund. Anyway, let me read your whole comment. A Vanguard diversified ETF, 90/10 asset allocation, listed on the Australian Stock Exchange. That's tricky. Looks similar to target date funds available in the US. Well, let's see what Morningstar will tell us about it. This is just a mass of information. Let's go back to the portfolio. So it's 100% 50, 80. Oh no, I'm sorry. So it is 90/10. It says it's 35% domestic, and I'm going to assume that means invested in Australian companies if it's on the Australian stock index, although we can look at that. We can come down to exposure here and go to country. Yeah, Australia. A lot in the United States. I mean, this is probably a solid fund. I don't know, you mentioned it's like a target date fund. What I don't know, and I can do a quick search here, I don't know if it actually changes its asset allocation over time, which is what a target date fund does as you get closer and closer to whatever the target date is. So I'm going over to Vanguard, their Australian site, which happens to be very slow right now. I'll show you in a second. Here it is. Let me make it a little bigger. Big fund, 1.5 billion. Management fee, 27 bips. Yeah, it doesn't look to me like it is a target date fund. Certainly, this doesn't seem to suggest that it is. So in a way, this would be maybe kind of similar to a life strategy fund, where you get one fund, it gives you a 90/10 allocation, but it stays at 90/10, or that's roughly their target. Sure, there's some variance, but not like a target date fund. And I don't have any opinion on the Australian market, but it looks like a low-cost Vanguard fund. So looks pretty decent. All right, I'm going to do one more question, and then I'm going to have to call it a day. This is an interesting question from Mike. When would you think an IPO becomes worthwhile for value investors to look at? First sign of profit or any other metrics to get ahead of the curve? So a value investor, I think, is going to probably not be excited about most IPOs, because it's rare that the absolute best time to buy a company happens to coincide with when company management decides it's the best time to sell. Obviously, we can go back in time and look at any particular IPO and say, well, if we bought on the day it went public and held it till today, we made a lot of money. But that kind of hindsight, I don't think is helpful. So I look at companies again based on their price and what I think is their intrinsic value. In a lot of IPO cases, I have no ability to give a reasonable valuation. Can you throw a small amount of money at it because you think it's an interesting business that could really do well? I suppose so. It's just generally not how I invest. So I've never invested in an IPO or a company that was recently went public. I don't have any sort of hard and fast rule on that. That's just not what I do. I like a lot of history. That's why I invest in the kind of companies I've invested in. And I like to buy them when they're not popular. When I bought Bank of America, people were talking about ARK. ARK was popular. They weren't talking about Bank of America. And it's the same with Apple. I mean, Apple's sort of always in the headlines, but I bought at 3 different periods when the market for Apple stock was taking a beating or down anyway, because something, they had a quarterly result that just wasn't appealing to some folks. And, it's worked out for me. Will it work out going forward? I don't know. But I'm just not. Part of it too is I wonder if I'm getting into the fear of missing out mode when I'm too focused on an IPO. So, Mike, I don't know that is helpful to you. I will say that if they don't have any profit, I'd be very concerned. I mean, I don't know what my basis would be in investing in the company. You could come up with some. It's just not how I think about it. And I would want enough history so that I had a reasonable degree of confidence that I could forecast future revenues and profits. Again, it would be a wide range. I wouldn't forecast them precisely. It'd be a range, and then I'm looking for a price that at a minimum is at the low end of that range, if not below. That's my approach. Well, there you go. Again, sorry I didn't get to all your questions. We've been at this 2 hours, and I'm exhausted. And I have grandfather duties. So I will look at the questions that I didn't get to. I will do some kind of video that covers some of them, along with in the email. I'm going to get a ton of emails. There's just no way I can answer them at this point, but I'm trying. I am going to have more pre-recorded videos on specific topics. Folks have asked about that. Yeah, they haven't gone anywhere, and hope to have a lot in January in particular, but we'll have some this year as well. And yeah, that's it. So no live Q&A next week. I may do a live show, but again, to address comments that have already come in, not to take new ones. And so that's it. Hope you have a great holiday. I don't know. I'm trying to think here. So I'm not going to do a show on the 23rd. I'll probably do a show on the 30th, though. Yeah, I'll be back in 2 weeks. So hope you have a great holiday. And until then, remember, the best thing money can buy is not an IPO. Not usually. It's financial freedom.